Thank you for attending this quantitative disclosure summary presentation. I am Kawai in JSCC's Clearing Planning Department, and I will be leading today's call. Today's meeting will be around 30 minutes, starting with a briefing on the major risk points. And we will try to address as many of your questions as possible within the schedule. In addition, on this webinar, as a topic for this quarter, we will touch on our new margin calculation methodology, BAR, for futures and option contracts, as JSCC is scheduled to migrate from SPAN to BAR for the listed derivatives margin calculation method in November 2023. All of the meeting attendees will be on mute, but if you have any questions, please let us know using the WebEx Q&A function. To begin with Mr. Miyauchi, JSCC's CRO will give an overview of the quantitative disclosures from the third quarter of 2022.
Thank you. JSCC keeps 64 billion yen of skin in the game, same as the previous quarter, mostly from JSCC's own capital, but it also includes contributions from affiliated exchanges. On aggregate, these were equal to 76% of JSCC's shareholders' equity. During this quarter, a stress test breach where the risk amount in extreme but plausible market conditions exceeded pre-funded resources was observed on one day for the cash security clearing service. The breach was resolved on the next business day through the deposit of required additional collateral. As for margin backtesting, the cover ratio for JGB futures and options fell below 99% in the second quarter. In response, and expecting further volatility in the JPY interest market, JSCC revised the margin methodology for JGB futures this quarter, resulting in the recovery of confidence level. More details of this revision will follow later. There were neither liquidity stress testing breaches nor any participant defaults during this quarter. JSCC experienced no suspension of the clearing services due to system failures or any other reasons during the past 12-month period. Now I will pass back to Ms. Kawai.
Thank you. Page 7 is an introduction of JSCC's service structure. Our clearing services are divided into 13 categories according to their governing regulations and product features, with each maintaining its own default funds. Please note that in this presentation, some data is presented across multiple categories as the resources may be shared. From the product perspective, number 1, cash securities, through number 3, index futures may be called ETP non-commodity, and the subset under this may be called ETP non-commodity derivatives. For number 2, JGB or Japanese government bond futures, and number 3, index futures, and the products under number 4, precious metal futures, through number 10, sugar futures may be called ETP commodity. From the exchange perspective, the products under number 2, JGB futures, through number 7, petroleum futures, may be called OSE listed ETP, because these are listed on the Osaka Exchange. From a regulatory perspective, the products under number 1, cash securities, through number 7, petroleum futures, may be called FIEA regulated ETP, because these are governed under the FIEA. And the products under number 8, energy futures, through number 10, sugar futures, may be called CFA regulated ETP, because they are governed by the CFA. Page 8 shows financial resources for participant default called skin in the game or SHIG, and contributions from relevant exchanges and PTSs. Most of the exchange contribution is from entities in the same corporate group as JSCC, namely TSE, OSE, and TOCOM. As shown in the left-hand table, JSCC's skin in the game for ETP non-commodity was 20 billion yen, which is shared by all of the relevant clearing categories. And for stress testing, the sufficiency of the financial resources for each category was tested by prorating these shared resources according to the relevant default fund amount for each category. Page 9 shows the ratio of SHIG to JSCC's capital. The left-hand graph shows the SHIG to be used before the mutualized default fund or DF, and the right-hand graph shows the SHIG to be used before the default fund plus alongside default fund of non-defaulting participants on pro rata basis. SHIG before default fund on the left ranges from 20 to 50% of shareholder equity, and SHIG before and alongside default fund is from 30 to 100% of shareholder equity. So JSCC contributes relatively large amounts of shareholder equity to SHIG compared to other major CCPs, which shows a strong commitment to risk management. Page 10 shows the required default fund, which will be mutualized among non-defaulting participants. The graph on this page shows the ratio of SHIG and contributions from exchanges to DF from members. The total DF requirement for all ETP, namely the aggregate of ETP non-commodity, in the upper left and ETP commodity, was about 404 billion yen. The ETP non-commodity DF increased by about 100 billion, but the trend was not significantly changed and the majority of the DF increase was attributed to the index future and option OSE. The IRSDF has decreased from the beginning of this year. This was mainly because the stress loss over initial margin, or SLOIM, decreased as a result of an increase in initial margin. While the stress scenario would not be revised to swiftly reflect the recent market move, the IM requirement increased due to the recent market volatility. Thus, the DF, which is equal to stress loss over IM requirement, decreased. We will touch on this later on as part of the review of IM on page 14. The category with the largest DF requirement was OTCJGB in the lower right chart, with an amount of about 309 billion yen. On page 11, the data is listed for these graphs, and the amount of potential assessment, or so-called cash call, is also provided. As stated in the footnote, cash call for NETD is capped at 3 times the default fund requirement, and for OTC products, it is capped at 1 time the default fund requirement. Page 12 shows the largest value and the mean value of the SLOIM, which is the stress risk amount exceeding IM deposited including add-ons. Please note that due to the PFMI quantitative disclosure definitions, the default fund on page 10 is the value as at the end of the quarter, but the SLOIM on page 12 is the largest or mean value during the past 12 months period. Also, I would note that the reason the SLOIM peak value for OTCJGB remained unchanged was because the peak value for this quarter did not exceed the value from the previous quarter. JSCC's default assumption is covered too, except for any listed commodity derivatives other than OSC Petroleum, which is the largest one plus the 5 firms with the smallest net assets. Among all clearing service categories, OTC-JGB has the largest loan, with a peak value of 359 billion yen. Page 13 shows the number of days there was a shortfall in the stress testing of pre-funded resources and the largest shortfall. As mentioned earlier, the number of breaches for ETP significantly decreased from 5 days to 1 day. This was because sudden extreme market movements and position increases were seen less frequently in this quarter compared to the previous quarter. Page 14 shows the required and excess IM amounts. The dark blue is the house IM requirements and dark orange shows clients. Light blue is the excess margin for house accounts and light orange shows client accounts. The required amount of OSE listed ETP, IRS, and OTC JGB were the largest at between 1 to 1.62 trillion yen. The IRS IM has been increasing since the beginning of this year. This was due to a change in the market interest rates. Because of a gap between the financial policies of increasing interest rates in other jurisdictions, such as the US and UK, and the BOJ policy of maintaining low interest rates. The weak Japanese yen has changed market participants' interest rate expectations significantly. Similarly, the IM for OTC JGB has also been increasing since the beginning of this year. The main drivers of this are similarly to those for IRS, but we have also seen position increases as well. Looking at the breakdown between house and clients, OSE listed ETP was driven mostly by clients. IRS was evenly split between house and clients, and OTC JGB was mostly house. This trend has remained unchanged for quite a long time. Moreover, the client's excess margin held was quite large in OSE-listed ETP and IRS, which has also not changed significantly. The data used for the graph on page 14 is shown on page 15 and 16. Now page 17 shows the number of breaches in IM backtesting for the past 12 months period. The number of new breaches was marginal compared to the previous quarter, except for ETP commodity. Page 18 shows that JSCC maintained the 99% cover ratio for all ETP as required under the PFMI. Please note that JSCC sets more conservative standards of 99.5% for CDS and IRS, which were also satisfied in the past 12 months. As reported in the previous disclosure, JSCC did not maintain the 99% cover ratio for ETP-JGB as required under the PFMI in second quarter of 2022. In response to those breaches, JSCC reviewed the price scan range methodology for JGB futures and options on September 5, 2022, enhanced it to improve the coverage of the margin requirement against market fluctuations. As a result of this revision, the cover ratio for ETP-JGB has been above the targeted confidence level of 99% this quarter. The chart shows the largest breaches in the past 12 months, which are about 10 billion yen for ETP-JGB 7 billion yen for energy, 55 billion yen for IRS, and 36 billion yen for OTC JGB. This test only looked at the base IM requirement without add-ons. JSCC has confirmed that these breaches would have been covered by resources such as IM add-ons, excess IM deposit or SHIG, and the whole amount of the default fund would have remained untouched. The upper chart on page 19 shows the quarterly largest value of variation margin, or VM, paid to JSCC, and the lower chart shows the largest value of IM called during each quarter. You can see that the VM was much larger than the IM. Page 20 and 21 show the composition of collateral used for IM deposit. On page 20, you can see that the majority of IM was cash, as shown in dark blue and dark orange, but some was in JGB and stocks, shown in gray and yellow. Cash collateral was held at either the central bank or at selected commercial banks. The secured cash deposited at commercial banks, in dark orange, was held in settlement account of commercial banks, which are fully covered by the Japanese Deposit Insurance Scheme. On page 21, you can see that the majority was deposited in cash but with some JGBs. Deposit of stocks are not allowed for these OTC categories. The entire amount of cash collateral for OTC JGB was held in the central bank, and for CDS and IRS, the participants or customers may select their custodian for cash collateral, i.e. Japanese trust account or the central bank account in the name of JSCC. The secured cash deposited at the commercial banks in dark orange for CDS and IRS was held in such trust account, which is legally protected from the bankruptcy of JSCC as well as the participant. Page 22 separates cash deposits into those for IM and DF. We were holding a total of about 6.7 trillion yen of cash collateral across all the categories. The amount was almost unchanged from the previous quarter. Next, page 23 shows the custodians for this cash collateral, with almost 100% held in either the central bank account, settlement accounts, covered by deposit insurance, or the trust account. Page 24 covers liquidity risk management. Please note JSCC risk appetite on liquidity is cover 2, but this data is presented based on cover 1, in accordance with the PQD guidance. And while JSCC separately calculates and manages default fund by category for liquidity risk, JSCC calculates and manages it across categories. However, for OTC JGB, JSCC has established a separate liquidity framework using repo with clearing participants, because the transactions under this category involve large amounts of principal settlement. In the chart, you can see that the liquid financial resources significantly exceed the required amount, and no breaches were reported in the liquidity stress testing. At the time of a participant default, at least the house portion of non-cash collateral could be liquidated and applied to the settlement with survivors. However, in this data, non-cash collateral is not deducted either from JSCC's payment obligation of the estimated payment or the actual payment. Because to be conservative, we consider that it could be difficult to swiftly liquidate such collateral on the date of default. So we do not regard such collateral as available liquidity resources. Page 25 shows the liquidity resources for the categories other than OTC JGB. The resources reported as cash at central bank on the first line and secured cash at commercial banks on the third line include cash in the DF related to ETP, where at least 50% of the required DF minus 1 billion yen must be in cash. The unsecured cash on the fourth line shows JSCC's own funds available for use as liquid financial resources following a participant default. The unsecured committed line of credit on the sixth line shows the committed liquidity available from JSCC's parent company and multiple commercial banks that have been designated as fund settlement banks and total to more than 1.5 trillion yen. The topic of this quarter is our new margin calculation methodology, VaR, for futures option contract. JSCC is scheduled to migrate from SPAN to VaR for listed derivatives margin calculation method in November 2023. One of the purposes of this migration is to make our risk management more sophisticated, such as to prevent a sudden rise or fall in the margin level and enhance transparency through the use of historical data, and optimization of margins through portfolio-level risk measurement. Additionally, we are enhancing the function of margin to protect stakeholders, including customers and dealers, from the credit risk tied to the potential default of other participants. Lastly, we aim to provide a safe marketplace in order to attract and onboard new participants by adopting a framework that is becoming the industry standard among global CCPs. You can see the timeline for implementation at the bottom of page 27. A revised version of the business outline was republished at the end of October, when the outline of the framework was fixed. At the beginning of November, a beta version of VaR margin calculation software was released and system development by participants is now in progress. Page 28 shows details of the margin calculation framework revision. JSCC will change the calculation methodology from SPAN to VaR. Major changes include the VaR-based PFE calculation and net option value and PFE calculated together. Move on to page 29 to explain an outline of the VaR methodology. Under the VaR method, JSCC sets margin at a level to cover 99% expected loss calculated from historical data, which adopt an average of the top 2.5% loss amount calculated from each scenario. It assumes a normal distribution. Theoretically, this should satisfy 99% targeted confidence level. In addition to the inclusion of historical scenarios in the look-back period, stress scenarios are also considered. Historical scenarios are adjusted to strongly reflect recent market conditions. Now we will move on to Q&A. If you have any additional questions, please let us know using Q&A function.
We received some questions in advance. The first one is, which kind of value at risk approach will be introduced? The listed derivative segment that will change from span to bar in November 2023. Well, JSCC will introduce the future historical simulation bar methodology with a look-back period of 1,250 days or 5 years. In addition, we will blend in some stress scenario to mitigate any procyclical effect. We are now calibrating details of key parameters, such as the number of stress scenarios to be blended and volatility scaling factors for the filtering methodology. The second question that we received before this session is, would like to know how collateral requirement or collateral amount pledged changed in 2022. How much does it reflect the trading volume or higher volatility? As we explained during this session, the IRS IM has been increasing since the beginning of this year. This was due to a change in the market interest rates because of a gap between the financial policies of increasing interest rates in other jurisdictions, such as the US and UK, and the BOJ policy of maintaining low interest rates. The weak Japanese yen has changed market participants' interest rate expectations significantly. In addition, a high volatility throughout this year has also been a driver to these IM increases. As for the OTCJGP IM, the main drivers of this were similarly to those for IRS, but we also saw position increases as well.
Third question we have received that we noticed that one breach is on stress testing for ETP, cash securities, which is resolved on the following business days through the required additional collateral. And could you please explain the additional margin framework? Thank you very much for your question. The answer is that we have an additional margin methodology. We call the additional margin to the participant whose stress risk is larger than the default fund amount. So this is our additional margin methodology in this case. And second one, which is related to this question, is it called to all participants or top 2 members only? Okay, this could be, we could code to all members possibly, but as I said, this additional margin is, we call this additional margin to the members whose stress risk is excessively large. So in practical, we only call this type of additional margin to the weak clearing participant with a very large positions.
Okay, then that was the last question we received. So with that, I'd like to wrap up today's webinar. Please do not hesitate to contact us if you have any additional questions after the call. Thank you for your time again. We look forward to posting next webinar and speak to you soon. Thank you.